Let's get started with the last session of the day before we go to the event that you're all here for, the reception. And the last session is about settlement and RTGS, and we're going to have Erhao Xie from Bank of Canada present, and Anton Barev from the Federal Reserve Board, will discuss. And actually, for personal reasons, Anton could not be here today, so he will join us through Teams right after the presentation. All right, Erhao, there you go. The floor is yours.
So thank you very much for paying attention to this last paper of today. So in this paper, Naren, who sits in the back here, and I are looking at the retail payment systems. So we are from Bank of Canada, so the Euro disclaimer applies. So I think because given this payment conference, I think most of us will agree that retail payment systems are really important. So they are critical financial market infrastructure. And here I just give you a few numbers. So in a typical country and for a typical year, so the retail payment system would normally process total transaction value that equals to a few or multiple times of this country's annual GDP. And here I give you the numbers of US and Canada. So this ratio would be roughly similar for other countries as well. So here we are talking about a really big number. So historically, these retail payment systems are usually taking the format of deferred net settlement, or DNS. So each system participant or each bank simply submits the payment order to the payment system. But those payments are not processed or not settled immediately. Instead, they will wait for a certain period of time, typically 1 business day. And the outgoing payment will be offset by the incoming payment. So each commercial bank only needs to settle in the net amount. Through this way, you can see each commercial bank really saves the collateral cost or liquidity cost. But as the Governor Warner mentions this morning in his opening remark, it's just that the payment really takes a long time to go to the recipient's account. So like in recent years, there is a strong demand or strong call for the really fast retail payment system, so or short for FPS. So here I just use this graph from CPMI's report in 2021 to give you a worldwide view of the FPS in the world. So in this graph, except for the gray area, which represents the regions who don't have any plan for FPS, all other colors represent the region that either they already have the FPS, like US or Brazil, or they have the plan to implement the FPS in near future, like Canada. So, and what's the features or what are important features of FPS? So in most of countries, the FPS will use a form of the real-time gross settlement, or RTGS. So in this RTGS, when commercial bank submits the payment order, it will be settled immediately. So it is really fast. But the gross payment must be fully backed by the collateral that each commercial bank pledged in the central bank. So even though it is really fast, it is immediate, but it requires a higher collateral cost. So, and this may remind you about the well-known or traditional trade-off between the delayed cost of the payments and the collateral cost for the commercial banks. And this trade-off is well studied in Beck and Garrett 2003 JET paper. Another interesting feature for this FPS is that for most of the countries, the introduced FPS will be served as an alternative to the existing retail payment DNS system. So they are not going to replace the existing retail payment system. So in most of the landscape, you will have two retail payment systems, one in the form of RTGS and the other in the form of DNS. And commercial banks can choose which system to process their own payments. And because this feature, it gives us a very interesting phenomenon that these two systems could be interacting with each other. So for simplicity, you can just imagine the RTGS. So in the RTGS, the other bank's incoming payment to me could be served as a substitute for my own collateral, because I can use the other guy's incoming payment to fill out my own payment. So this has an interesting interaction. So if the other banks use less frequently about the RTGS, instead they use more about the DNS, then my incentive of using the RTGS should be reduced. And this is the interaction we mean across different payment systems. So what we really do in this paper is that, so we focus on the framework of Beck and Garrett that focus on the delayed and collateral cost trade-off. But we do two important extensions. So here, so in Beck-Garrett, they study the interaction between system participants, but within a single payment system. And here, we still have that channel, but additionally, we further study the interactions between different payment systems, like the interactions between RTGS and DNS. So in Beck and Garrett, the delayed costs are homogeneous across bank and across payments. So if the delayed costs are homogeneous, then there will be no interesting interaction between systems, because in the equilibrium, banks will simply use only one of the systems. They will either use RTGS or DNS. So here, the other important extension we do is that we allow that each bank's payments to have heterogeneous and stochastic delayed costs. So through this way, you can imagine that some payments that is really urgent, they will be settled in RTGS. But some payments that are not urgent enough, they will be settled in DNS. So there is really some interesting trade-off between RTGS and DNS. Okay, so why you may care about the interactions between different payment systems? So because by studying this thing, we can actually evaluate each of the following three payment system configurations. So here is really the configurations. So the first configuration, you can imagine you have an economy. It has a single payment system, and it is in the format of RTGS. So the second configuration is that you still have a single system, but that system is in the format of DNS. The third configuration is what we really build in this paper is that, the economy or this country has two different systems together, and the commercial banks can voluntarily choose which system to go. So, and for each of these three system configurations, we first derive their decentralized equilibrium outcome, and we then compare the total cost of processing the payments. So here, we really focus on the system participants' point of view. So we kind of shut down the channel for this implication for the end users. So here, the cost of processing payments really mean the delayed cost plus the collateral cost here. So, and comparing these three system configurations will give you some, or give us the ability to answer a few interesting questions. For instance, here, suppose you consider an environment with DNS only. So you can think that's our old landscape of the retail payment environment. And when we have two joint systems together, you could think that's our current landscape where we already introduced the FPS, and this FPS exists together with the existing DNS. So by comparing the first two, we could answer the question that whether the introduction of FPS is beneficial. And the last configuration, the RTGS only, you could interpret as the following way. So after we already introduced the FPS, how do we do with the existing DNS payment system? Should we just eliminate or should we still keep it? So by comparing the second and the third, we could answer the question that should we eliminate or should we just remove DNS after we introduce the FPS? So here we are really going to answer these two questions in this paper, but just from a system participant's point of view. So here is our first key result. So compared with DNS only, if you have two payment systems, then the total cost of processing payments will be strictly lower. So that means what we are doing currently is correct, so we should introduce the FPS. It will reduce the system participants' total cost of processing payments. So why? You could think that when you additionally introduce an RTGS for really urgent payment who has a higher delayed cost, they will be settled in RTGS without any delay. So even though those payments will incur a collateral cost, but because those payments are really urgent, the saved delayed cost is higher than the increase of the collateral cost. So introducing FPS or introducing another RTGS would be beneficial. However, whether we should still keep the existing retail retail DNS system would be ambiguous, and it depends on few factors. Why? It really because of the interaction between the payment systems. So here you can think compared with an environment with only RTGS, if we have two systems, then you could imagine that the other bank will switch some non-urgent payment from RTGS to DNS. And because the interactions among systems, so that payment migration to DNS will reduce my own preference for the RTGS. So in RTGS, there will be less payment to be settled. So there will be an increase of the delayed cost. However, because some payments migrate to DNS, it will save collateral costs. So it really depends on the distribution of the delayed cost. Will really depend on the distribution of that delayed cost and its comparison with the collateral cost. And another important feature is that, okay, this comparison between RTGS only and the joint system doesn't depend on the size and the distribution of the really urgent payment. Why? Because in any configuration, you have RTGS. So for really urgent payment, they will be settled in RTGS without delay anyway. So how many really urgent payment or what they are delayed costs, whether they are like infinity or infinity minus one, doesn't really matter because they will be all settled in the RTGS. Okay, just a recap of Beck and Garrett framework. So they focus on the RTGS system, and they have two banks denoted by I and J, and we have 3 periods in the day: morning, afternoon, and the end of day, or EOD. So in the morning, each bank will independently receive a payment request with probability P. And this payment request is initiated by each bank's client. So the payment size is normalized to just $1. So, and the banks can maybe process this payment immediately without incurring any delayed costs. Or if this payment is not settled immediately, then the bank I will bear a delayed cost D. So you can interpret this delayed cost as some cost on the consumer side, but the commercial bank internalize that cost. So it's really the benefit of faster payment on the consumer side. And how much banks could internalize that benefit will depend on the competing feature for the end user, here which we don't model. So there is just a delayed cost for the bank, as in Beck and Garrett. So what we further do is that, okay, so this delayed cost D is no longer the same for every payment. So here we assume that at the morning, you receive a bank payment request, and the delayed cost will be in the IID draw from an exogenous distribution. So you can think that in everyday economic life, it will generate very different payments with different urgency level. Some payments are really urgent, but some payments are not so. Okay, so in the afternoon, it is very similar in the morning. So you will receive a payment request with probability Q. And here we, because it's already in the afternoon, so approaching end of day, so any afternoon payments will incur zero delayed cost. However, here we assume that banks must settle all their payment obligations by the end of the afternoon. So they can delay their customers' payment, but they must fulfill their customer payments request. They cannot say, okay, you let me to pay the other guys $100, but I don't perform this task. They can delay, but they cannot not say no to their customers' request. Okay, how about the liquidity? So in each day prior to the morning, each bank just start with zero liquidity. So in each period, like morning or afternoon, after observing their payment request, then each bank has an option to pledge a collateral in exchange of the liquidity. So if I pledge 1 unit of collateral, I can clear 1 unit of payment request. But this unit of collateral will have a unit cost C per period. So it's really the opportunity cost of the collateral. So, and if I have 1 collateral in the morning and 1 collateral in the afternoon, then I will pay cost 2C. So, and suppose Bank I in the morning receive Bank J's incoming payment to Bank I, then in the afternoon, Bank I has 1 additional liquidity. So if Bank I has afternoon payment, Bank I can use this incoming payment to pay its afternoon obligations. So because the incoming payment serves as a substitute of my own collateral, this is the key channel that generates all the interactions here. So following Beck and Garrett, we assume there is an intraday money market. So that means if Bank I does not have the afternoon payment obligations, now it will have an actual liquidity in the afternoon. So they can lend out this actual liquidity at price C in the afternoon. So this is just to be consistent with Beck and Garrett. And our main results really do not depend on the existence of the intraday money market. But this presentation, I will show you the result with this intraday market. So what really important in our model is this overnight market. So because of the payment inflow and outflow at the end of the day, each bank may have excess or overdraw of liquidity. So we assume there is an overnight market at the end of the day to balance this imbalance position. So there will be a market clearing condition such that the borrowing rate equals to the lending rate for the overnight market. And we assume this rate should be the same across different payment systems. So if you borrow $1 overnight, it doesn't matter whether you borrow in the RTGS or DNS, you share the same rate. So because you share the same rate, the profits in the overnight market will be solely depend on the daytime payment inflow and outflow. And this payment inflow and outflow is solely dependent on the customer's require. So which banks does not have any control. So because of these features, the profits and loss in the overnight market could be excluded in our analysis. So in our analysis, we only focus on each bank's total cost, which is defined as the collateral cost plus the delayed cost. So this is pretty much the back-end Garrett with heterogeneous delayed cost. So what we additionally do is that we also consider what happens in the DNS. So here we consider a really simple DNS, which everybody just submits a payment order in the system and without doing anything. And all the payments are just delayed to the end of the day, calculate the net value, and settled in the net value. So banks just bears all the delayed costs, but they don't bear about the collateral costs. So here you can think maybe there will be a collateral cost for the DNS, but it's smaller than the RTGS. So the DNS's collateral cost is normalized to 0. So no collateral cost in the DNS. So for today's presentation, we will make 2 simplified assumptions, though our results hold more generally. So the morning payment will be received with certainty. So you will have a morning payment request and no afternoon payment request. The only uncertainty and asymmetrical information comes from the stochasticity of the delayed cost. So you still have a game with incomplete information. So let's calculate the equilibrium of 3 different payment configurations. The easiest one, of course, is the DNS only, because every payment is simply delayed to the end of the day without incurring any collateral costs. So each bank's total cost here is just the expectation of the delayed cost, ED here, which in the integral form could be in the very right. So this is the DNS only. For the RTGS only, so as in the back-end Garrett, so each bank's behavior could be perfectly summarized by its strategy in the morning or for the morning payment request. And each bank's strategy will be summarized by the strategy function. So given the delayed cost DI I have, I will have a binary choice. So I will either process this payment immediately or delay it in the afternoon. So, and now let's see how my total costs are from my 2 choices. So say if I send my payment immediately, then my payoff will depend on whether the other bank sends me the other bank's morning payment. So if Bank J also sends its morning payment, then for Bank I, because in the morning I need a collateral to clear my payment, so I will have a collateral cost of C. But in the afternoon, because I receive Bank J's morning payment, I have an additional liquidity to clear my collateral, so I don't need any collateral cost in the afternoon. So my total cost will be C. On the other way, if Bank J doesn't send me the morning payment, then in the afternoon, I still own 1 level of liquidity or still need to pledge the collateral. So I also need to pay a C in the afternoon. So I have total cost of 2C. So this is what if Bank I sends its morning payment. What if Bank I delays its payment? Well, the second part is the same. It's just the first part in the morning, I no longer bears the collateral cost C, but instead I delayed my payment, so I bear the delayed cost DI. So through this comparison, you could easily see that a dominant strategy for Bank I will be I send the payment in the morning if the delayed cost is greater than C. And I delay this payment if my delayed cost is smaller than C. So then every bank use this strategy would be a unique basic Nash equilibrium of this game. So given this strategy, we can also calculate each bank's expected cost in this RTGS only environment. So basically, it will be equal to C which is my expected collateral cost using RTGS. And plus the second term here would be my expected delayed cost. Because only payments with delayed cost smaller than C will be delayed. So it is the probability of that event multiplied the conditional expectation of the delayed cost. So will be the second term here. So I would better to speed up. So this is what really interesting in this paper, that we have two systems together and what's the interaction between the two payment systems. So when you have both RTGS and DNS, and imagine you still have an afternoon payment obligations, then in this way, because this payment is delayed anyway, so it won't incur any delayed cost anymore, regardless of the system. But if you submit this system payment to the DNS, you would save the collateral cost. So it's optimally to send the afternoon payment into the DNS. So in this environment, if you delay, you must delay in the DNS. And again, the strategy will be summarized by this binary choice. So given DI, in the morning, whether I send this payment immediately in the RTGS or whether I delay in the DNS. So I will ignore the derivation here due to the time constraint. But when you have two systems together, you will see the strategy is actually the second line here. So you will have the same threshold strategy as the environment of RTGS only. But here you just have a higher threshold to be switching from delay to send. So the threshold now is 2C instead of C. So why you have a higher threshold? You can imagine that this is perfectly because of the interaction between different systems. Because when you introduce a DNS, then my opponent, the other bank, will switch some non-urgent payment from RTGS to DNS. So I'm less likely to receive the other guy's incoming payment. And it reduces my incentive to use RTGS. So I really use RTGS to clear really urgent payment. So the threshold of that delayed cost actually increase. So that's the same. Okay. And here, given this strategy, we can calculate each bank's expected cost under RTGS and DNS. It will be in this form. So with this probability, I will delay my payment, and this is my expected delay cost. And with this probability, I will not delay my payment, and I will pay the collateral, morning collateral costs. So that's the format of that. So, and here is just our assumption on the distribution of the delayed cost. So you can think, okay, so we have 3 types of payments: low delayed cost, medium delayed cost, and high delayed cost. We just assume each type will take non-zero probability. So that we think that's a reasonable assumption because there will be many payments with different urgency levels. So again, this is a total cost for each payment configurations. So our first comparison is the DNS versus RTGS plus DNS. So here, when you subtract the cost, you will see the DNS only will give you a strictly higher cost. This is, again, because when you introduce RTGS to an existing DNS configuration, really urgent payment will be settled in RTGS without delay. And even though you pay higher collateral costs, but this urgent payment has really higher delayed costs. So you save more delayed costs than the collateral one. So you are strictly better off for the system participant. However, for the RTGS only or RTGS plus DNS, the comparison is not so. And it actually depends on two interesting features. So Here we just simulate the cost.
Use the microphone. And you have 1 minute.
Yeah. Okay. So yeah. So here is really the difference between RTGS only minus the joint systems. So and the gray shaded line is 0. Actually, you can see in most of the scenario is like the joint system or two systems together achieve a strictly lower cost than the RTGS only. But in some scenario where you have extremely more or extremely high fraction of medium payment, medium delayed cost of payment, the RTGS only could be cost efficient. So, and we also derive the social planner's solution for each system configurations as a backup here. So let me summarize here. So basically what about this paper is that, so our environment is almost identical to Beck and Garrett 2003, but with two important extensions. The first extension is that we really focus on the interaction between systems, not the interactions within a system. And we allow heterogeneous and stochastic delayed costs. So through these two simple extensions, you could see we achieve some interesting results. So first is that the introduction of FPS that exists together with the existing DNS will strictly lower the total cost of processing payments. And the second, whether the existing DNS should be phased out or not really depends on the relative distribution between medium type and low type of delayed costs. It doesn't depend on the distribution or the size of high type payments. So I will stop here and I'm looking forward for the discussion. Thank you.
Good afternoon, and thank you very much for inviting me to discuss this paper. I think that during this time of peak interest to the payment industry, the authors picked a really interesting and I would say central problem, a central question of arranging how to arrange a payment platform. Could you advance the slide, please? Thank you. Historically, payments accumulate and the resulting net positions are settled at the end of the day. We know this arrangement has been for a while. More recently, there's been increased demand for fast or instant payments, where each payment is processed instantaneously. So here, what the authors want to answer is how we can, which arrangement is dominant in terms of equilibrium. They use modern tools to think about strategic interactions and welfare. So I think that the topic is very relevant, and basically such analysis hasn't been considered by the literature. I even would think that more interest should be spent in this direction. The context, again, couldn't be better picked. In Canada, we have a multi-year modernization of the payment system. In the US and Europe, we have complex hybrids. So in the US, we have both Fedwire and chips. In Target 2, there are various queues for submitting payments. There are other payments arrangements that involve more complex arrangement as opposed to just one on another. So the thinking about how to combine these two arrangements, I think, is right on time. In addition, I would argue that this analysis has implications for the fast-growing DeFi industry. So I think that payment systems that are based on cryptocurrency, they don't avoid this question. So this is pertinent, though at this point slightly forgotten. The current high interest rate environment makes the analysis even more relevant because of the increasing collateral costs or increasing liquidity costs. So again, this all speaks in favor of how how interesting is the question that is being posed. Next slide, please. So the model is a familiar model of Beck and Garrett with a couple of modifications. I'm going to be very quick here. There are 2 players, 3 periods. Importantly, payments requests differ with respect to their urgency, which here is captured by a delay cost parameter and liquidity cost. So there are 3 cases to consider: deferred net settlement, real-time gross settlement, and the hybrid system. The most simple case, deferred net settlement, where banks submit the payments immediately but settle only in the afternoon, is very transparent. There are no choices here. The expected costs are just the expected delay cost. Next slide, please. In a real-time gross settlement arrangement, what drives the payoffs is the decision in the morning. So this matrix of payoff, these are the payoff of the role player, captures pretty much the game. The game is very transparent, very intuitive, and it's very easy to see what exactly is going on. The couple, I just want to mention a couple of features of this game. So specifically, if you consider the send outcome, the role player incurs the cost of collateral in the morning. She does not incur cost of collateral in the evening because she's being paid immediately, and a QC, which is the expected cost of a collateral for a random payment that is being posted in the afternoon. In any event, the difference between the rows is a constant for both columns, and it equals to the difference between the delay cost and the collateral. The difference between the column, in turn, is just the extra delay cost. The extra collateral cost that the role player incurs in the afternoon because she's not paid. The dominant strategy equilibrium is obvious. Send in the morning if delay costs are large enough. Here, the delay costs are larger than the collateral cost, and one can zoom in and stare a little bit at the expected cost to see that they are very intuitive as well. I'm going to skip this one. I'm just going to mention that the socially optimal play is to always send, even if the delay costs are small. So here, right away, we have this wedge between the equilibrium and the socially optimal play. Deep down, there are 2 reasons for this, and I would love to see a little bit more intuition of why, how they play exactly with this game. There is externality, 2 times the collateral cost. There is extra collateral cost if you play a random with respect to the other player policy, which depends on the delay cost, and there is a coordination cost. And the coordination cost is just C, but I would love to see a little bit more on this. In the interest of time, I'm going to move on. Next slide, please. In the hybrid system, where we have both the deferred net settlement and real-time gross settlement, in the second period, the dominant strategy is to use DNS. The first period play is here. The structure of this game is very similar to the one before. It is very transparent. It's very easy to see what is going on exactly. The dominant strategy equilibria are to send in the morning if the delay cost or the urgency of the payment is very large. Now, compared to what we had before, DI here being above 2 times C is a strategy to send. Compared to D being greater than C, the expected costs are very intuitive, and you can see easily if you stare at just a minute, which we don't have this minute, but if you stare a little bit, you'll see that these expected costs are lower than what would have been the expected costs under the deferred net settlement. Why? Because when the delay costs are large, now we have this extra option of making payment in the morning. Basically, the hybrid system compared to the deferred net settlement system gives the extra option of paying in the morning. And this creates this welfare improvement. Looking at the socially optimal play is to send not only the very urgent payments in the morning, but also those that have intermediate urgency. By intermediate urgency, I mean a delay cost that is above C and less than 2 times C. C again is the collateral cost, liquidity cost. Again here, both externality and coordination are at play in creating this wedge between the socially optimal play and the equilibrium outcome. Next slide, please. Very quickly about the welfare analysis. If you look at the equilibrium outcomes, which is at for RTGS, is to ascend in the morning if delay costs are above C. For the hybrid system, is ascend if delay costs are above 2 times C. The socially optimal play always involves paying more in the morning in comparison to what is the equilibrium play. So if you have a way to induce more payments in the morning, then you close the gap between the equilibrium outcome and the socially optimal play. And this is, next slide, please. And this is where I believe that this could be the next step in terms of developing this analysis. So to recap it, the authors argue that heterogeneity in payment urgency is important. In this particular model, they show that introducing real-time gross settlements always improves the welfare. This is very intuitive and is very cleanly formalized by the authors, while introducing a deferred net settlement is welfare improving only whenever certain payments with marginal urgency. These are exactly these intermediate urgency payments. They're supported enough in the distribution. I do believe that this is a very interesting. These are very interesting questions. I do believe that the framework that the authors extend have the potential to answer to analyze additional policies. Specifically, what comes to mind is that deferred net settlement could occur with additional morning settlement cycle. Instead of settling in the evening, one can conceive of settling in the morning as well, have an additional settlement cycle. What I have in mind is the practice of chips, where we have netting coming closer to this, or what is in Spain, the Mexican large value payment system. So having more settling cycles throughout the day, but stylistically captured by just additional settlement cycle. This, I think, it's something that authors can analyze as well. One additional policy that I think is going to be very interesting, and I do believe is very timely for this, is to discuss dynamic pricing of the daylight overdraft. Specifically, one can think about intraday liquidity subsidy, where the morning daylight overdraft are subsidized at the expense of the evening ones. And on the left here, I have modified their game to include such a feature. So you see here now that you see at 10 cents. So these are the payoffs of the role player. The payoffs of the role player. Now we have C1, which is the liquidity cost in the morning, and C2, which is the liquidity cost in the afternoon. Now think if C1 is less than C, what was C before. The more you drop C1, the closer this payoff is going to be the closer the outcome of this game is going to be the socially optimal outcome, which for RTGS was to always send in the morning. So this is something that is not far-fetched to close this gap between the equilibrium play and the socially optimal play. On the right, this is something that actually motivates me to think in this way. This is the PDF of daily payments value from a working paper, Fed's working paper with Dave Mills and Jeff Marquardt. Here we see that in 2004, the bulk of the payment were done after 3 p.m. on FedWire, while here in 2012 and 2020, you see this bump of a mass of payments that are moved towards the morning. So such policies can be rationalized in some way with daylight overdraft. So finally, this is a little bit more bold suggestion, is that maybe this model can be reinterpreted in the context of repeat interaction. So we know that payments they involve repeated interactions. So what is special once we start thinking about repeat interactions is that there is a presence of reputation, and one can sustain a cooperative of equilibrium stage outcomes. While I think that developing a dynamic game is not what I have in mind, but just maybe thinking or interpreting some of the parameters of the model in this direction, I think this is something that would be very interesting. So overall, I think this is a very interesting topic. I think the model has even more to offer in terms of analyzing additional policies.
I should have started walking sooner, sorry. Thank you, Anton. All right, in the interest of time, actually, we're going to set up for the reception. So we actually have sort of a 30-minute break, essentially, but we'll go up a little early. But what I want to do is we'll have Karen, who is the person in the green sweater right there, and Jesse, who was the person holding the mic earlier, who will shepherd the poster presenters to set up the posters. So whoever you are, please go to those two fabulous women, and they will bring you where you need to be. Now, for everyone else, you need to pack everything. You cannot leave anything in this room. You will not go back here.